Hello and welcome to Money Control. Well, after the sharp sell-off in Midcaps on Monday morning, yesterday and today, the markets have been kind of soft. Today also, the market seems to be starting off on a bullish note, slightly bullish note though. Yesterday, one piece of information that came out, the data that came out, the US CPI, was along expected lines. What do we have in terms of global cues, and what is the domestic sentiment like? How are the foreign investors looking at India? I have with me an important, powerful voice from Julius Baer, Mark Matthew. Mark, thank you so much for joining me this morning.
Thank you for having me on your show.
First of all, Mark, what do you make of the US CPI data that came out yesterday? The market seems to have shrugged it off. It was pretty much on expected lines. The core inflation mildly higher in terms of overall CPI number. What is your sense? What do the inflation numbers look like looking ahead?
Exactly as you said, it was not a surprise. I don't think there was a single item in the entire CPI that is worth noting. Everything was exactly as expected. So the gasoline prices were responsible for the rise in the core that was entirely anticipated. I'm sorry, the headline. And then the core, which did modestly decelerate over July, was brought down in part by the rental prices. And if we look at the real-time rental indices, which the core reading tends to lag by about 9 months, they have come down a lot. So we can be quite sure that will continue to drive the core down. And property, what they call shelter, is 40% of the core CPI, the core CPI being the one that the Fed really focuses on. So when we look at the Fed fund futures, we can see that the market has basically decided there will be no more rate hikes, or at least the chance of them is extremely low. And I think that's correct. I think that the last rate hike happened in July. Then the next question is, what about when we get a rate cut? And there, I think because the economy is so strong, it's unlikely there will be a rate cut for many months to come. The average gap between the last rate hike of hike cycles and the first rate cut of cut cycles is around 10 months. And I think that would be also about the same amount of time that we could expect before the first rate cut this time. In other words, it should be possibly sometime in the summer next year.
All right. What is your sense of crude, Mark? Because that seems to be inching higher. There is no demand slump, but there is a supply cut that is happening both from the OPEC and the ability of US to sort of make up for that shortfall. Do we now reconcile to crude, settling at a higher band upwards of $90? What's your general sense?
No, our sense is it's going to come back down. And the reason it went up was the Saudi production cuts, which have been extended until the end of the year. Saudi correctly can see that with China in a funk and Europe in a funk as well, there will be less demand, and therefore they can cut production to sort of respond to that slower demand. But at the same time, we reckon that about 80% of the Saudi production cuts will be made up for by increased production from Russia and Iran and Venezuela, so-called rogue states, if you will. And there is new supply coming online from Brazil and several other sources. So with these high prices, other suppliers will come in and take advantage of them. And we look for oil to go back down to about $75 a barrel next year.
So you do think that this is only a transitory kind of move, because crude indeed is at a 10-month high now?
Yes, we do. And we think, as I said, that the other producers, apart from Saudi, will take advantage of this high price to pump more. And Saudi doesn't want to do all the hard work forever by itself. Why should it be reducing its own output by 1 million barrels per day if all of a sudden other countries come in and fill that void? So ultimately, we think there's lots of supply out there still, and it will help to bring down the price.
Are you also assuming a slump in demand in China because the import numbers, crude import numbers in China doesn't seem to be showing any signs of slowdown?
Well, the crude import numbers in China, China's never really been the marginal driver of oil prices. It's more the United States, actually. And I don't entirely know the reason for that. China certainly has been the driver of industrial commodity prices in the past, but not so much oil. And so I would only say that the fact that their economy is very slow is an additional reason why we shouldn't expect oil to continue rising further.
Okay. And in terms of commodity prices, what is your sense? Because there has been quite some buoyancy there also. What's your sense there?
There's really only two commodities that we like, which are nickel and copper, and that's a function of the transition to electric vehicles. Both of them, a lot of it is required for the infrastructure that needs to be put in place to accommodate electric vehicles and also for their batteries. But apart from that, we think that generally commodities, there's ample supply. And generally, economies are becoming more efficient with improved technology, and so they require less commodities, and that includes for oil.
Sure. And in terms of China itself, what are your assumptions in terms of growth? Where do you see it go from here? Because one of the reports in by the global survey by Bank of America showed that China property credit risk now is on top of the radar for most global fund managers. Is that a real concern? SEC has also asked for data on, exposure to China property from financial institutions. So what is your sense? Is that an important risk? How do you perceive it?
I don't think it is for the financial markets because most of the Chinese property bonds, both onshore and offshore, are owned by wealthy people who, of course, it's painful for them to not get their money back, but they can generally accommodate it. It's not like mom and pops are the ones who own this stuff. And I don't think we'll actually see outright defaults. It'll be more just a continuation of extension of repayments and court processes. So technically, I don't think we're going to see defaults, but they will end up becoming de facto defaults anyway. The property sector in China clearly has been something the government wants to see become a less meaningful part of their economy. And I think that's entirely a good decision on their part because about 20% of the residential stock is not being used, which is about 50 million units. So both property and infrastructure were drivers of their economy, but there's oversupply in both. And they've decided to take the tough medicine now. You have to take it sometime and reorient their economy to more productive sectors. That is a painful process, and it will mean low growth for the next few years. And then I think we'll look back a few years from now and realize that it was the right thing to do, but it is a painful process.
Sure. What is your sense on the dollar index, Mark? Because that again is at a 6-month high, but inching slightly lower, obviously on some kind of cue from the inflation data and the way the interest rates are headed. What is your sense on the dollar itself?
Simplistically, if we take the view that the Federal Reserve won't raise rates anymore, then the spread of Treasury yields over government bond yields in the rest of the world should not continue to expand. But it is rather high. I mean, you get a much better yield in the US than Europe or China or Japan or most other countries. And so I would say that the dollar is a good currency to own, but I don't expect it to continue rising much more from here because it looks like the Chinese and the Japanese don't want to see their currencies go down much more. Yeah, so I don't think the dollar is going to rise much from here, but I don't see it collapsing either.
Okay. The corollary to that is, what does it mean for emerging market fund flows?
Well, I feel the asset class is outdated, and there's just too much going on within these countries, China, India, Brazil, Russia, and all of the smaller ones. So I'll just start with China, which is the largest, of course. Well, I already talked about it. So it is the one market that is not doing well this year, and I can't see why that's going to change. The only thing that would prompt them to change is if they had a very bad deflation, and they don't, actually. The most recent inflation reading was slightly positive again. I think you'd have to see things get much, much worse in China for any kind of major stimulus on the part of the government. And then the next one on the list is clearly India, which is breaking out. And after a consolidation since 2021, the major indices are breaking out. And I think it's a good story, and will continue to move higher. And then you get it into Russia's not investable. Brazil is quite exotic. Smaller ones are hard to keep on top of. So putting it all together, I figure that India will be the one that attracts the most attention.
Sure. So there has been a lot of bullishness around India, Mark, on account of three factors. One, the very fact that there has been a lot of reform underway, which is going to have a profound impact on our, growth trajectory over the long term. Next is, an investment-led cycle that is being talked about, and of course the global context in terms of geopolitics. For you, what is the, what do you perceive as the most important factor that'll have an enduring impact in terms of India growth story?
It's hard to choose because there's a lot of good things happening. But if I had to choose one, I think it is that the reforms you described have allowed the government to build infrastructure, physical infrastructure, with improved tax collection. And so there are highways and improved electricity, airports, ports, etc., that can accommodate the manufacturing sector in a much more meaningful way than before. And so I think that, India was always sort of an agrarian/services story before, but now there's a very real chance that you can get big manufacturing in India. And of course, that can be used for the domestic market, which will help bring down imports and therefore the current account deficit. But also they could be exports, and that also would be very useful and a powerful thing for rectifying the current account into a surplus, and in turn would be a beneficial force for the rupee. And the thing that usually keeps global investors away from emerging markets is that they don't want to lose money in the currency. Case in point, India. Rupee has lost over 50% of its value over the last few decades. If that's a thing of the past, and we continue to see stability in rupee, then I think you would naturally see much more foreign fund flows into the country.
Sure. And do you see that changing over the next decade? I mean, what is the long-term trajectory you see for the rupee? And is that having a substantial impact in the way foreign investors view India today?
Yes, as I said, it is. And I think the longer the rupee is stable, the more that will be noticed. And it takes a few years to change people's views on a currency which has been in a sort of structural decline for as long as the rupee. But if manufacturing really will become a major sector and driver of the economy, then I think it's absolutely intuitive that the rupee not only stops going down, possibly even becomes a currency that goes up. And if India increases its efficiency and productivity, become less reliant on oil, or at least it will be able to use oil more effectively. So, yeah, that's what I think.
Sure. Mark, there has been this narrative that India is now, gaining some kind of credibility as an asset, to be an asset class on its own. Do you think that transition is already underway, or how credible is that story?
I haven't heard that one before, and it's not big enough yet, in my opinion. correct me if I'm wrong, I think the market cap of India is a bit over $3 trillion. So I mean, that's
I mean, I was just reading about this in the Financial Times, where they're saying, there are large funds which are saying that they no longer want to invest in China, and they're looking at ex-China products in terms of indices, custom indices, etc. So there are early signs or cues in terms of, if China is because that's the largest weight. If you take that out, then the rest of amid the rest of the emerging economies, India may look like a significant part of it. So that's where I'm coming from. But go ahead and tell me, what are you hearing and what is your own perception?
I agree with that. And what would be especially meaningful is if Korea is moved into the developed markets next year by Morgan Stanley Capital International, and I suspect it will. That would make India even bigger in the emerging ex-China asset class, because I think Korea is #2 after Taiwan. And so, yeah, I mean, if you go down the pecking order of the emerging markets, let's say Korea leaves, so Taiwan's the biggest. But let's face it, Taiwan isn't really the kind of emerging market that people, when they look to emerging markets, they're looking for big populations, they're looking for growth. Taiwan is essentially a very high-end semiconductor story, and it has significant vulnerability in being, adjacent to China and potentially being taken over by China, invaded by China. So then I discussed earlier, can't really buy Russia. Brazil you can look at, but actually Brazil's economy is very, very, very coupled to China because of their soybean and oil and what's the other big thing they've got there? The exports to China. And so you go down the pecking order and then you get into, much smaller markets. They're interesting. It's not that they're not interesting, like in Indonesia or a Vietnam, but they are small and people only have so much time to look at things. And each country does require an equal amount of time, whether they're small or big. So I do think that naturally attracts people to India because it is the largest of these countries that I've just talked about.
Sure. And Mark, tell me about, how are large foreign institutions really looking at asset allocation now? Because if we were to assume that China is a big part of the index, is a lot of money flowing away from passive to avoid China and getting into active so that there is more active call on country allocations? Is there any other trend that is underway?
Well, I hadn't ever thought about that until you said it, but it should be intuitive that if you don't want to own China, you have to buy emerging markets ex-China, and you can't just buy an emerging market ETF because you'll be owning a lot of China. And I think those products are being created now. There are emerging market ex-China ETFs and managed funds. But you earlier asked about just generally asset allocation, and I do think that one thing is with the Fed funds rate having gone from 0 to 5% in 18 months, there are lots of bonds which are attractive for the first time in over a decade. And so the bond market actually is taking a lot of oxygen away from the stock market simply because you're getting very good yields and across the spectrum, but including in high quality investment grade corporate bonds where obviously the risk and the volatility are much lower than with stocks.
Sure. And do you see this continuing for a while? Because we are still, like you also said, we are still quite some away from rate cuts. So will bonds continue to attract attention, over the course of next year?
I should think so, yes. I mean, if there's generally a view that rates are not going up anymore, then now's the time to be locking in good yields.
Right.
And as we get toward the first rate cut, which, as I said, we think should be next summer, you could start to see some capital appreciation in bonds too. So, yes, I do think that. And by the way, I actually should be a little more specific when I say bonds have taken oxygen out of stocks. The performance of bonds has been mediocre. They're basically flat on the year. If you look at Treasury returns, for example. But I don't think that will continue. And in fact, Treasury returns, 10-year Treasury returns were down in 2021. down in 2022. They're flat this year, but there was never a year when they were down for 3 years in a row. And it's one series that we can go back remarkably far. We can go back to the year 1790 for Treasury returns. And so I don't think they'll be down again this year. And so we think that that's sort of the best place to be. That would be the top of our pecking order, would be investment grade bonds.
Sure. And for this year, what is your outlook for, India? What kind of weight are you associating for India?
Well, all I can say is we're overweight, and we think it will continue to go up. And as much as you and I have been talking about foreign fund flows, the more powerful force is the local funds, which when you get the local funds to a certain size, it becomes a very big cushion for the market. And the systemic investment plans that have been rising over the last few years, just the number of accounts that have been opened, I think that will continue as the per capita income of India rises, which it should, because the working age population is getting bigger and bigger, and you have sectors of the economy that are growing strongly, like technology, which pay more. So that local buying is a very powerful force. And there are countries we can look at, if I mentioned Australia, for example, or Malaysia, which have these sort of big retirement plans where every month people are putting a little money in the equity market. To me, that's the much more meaningful thing to not only provide a cushion to the market, but continue to drive it higher over the long term.
Sure. And Mark, are there any specific sectors or themes or segments that you're particularly bullish on? Tell us your top three themes that you're playing.
I suppose that we like the banks, so does everybody, but we like the banks because their non-performing assets have been brought down to a very low level, and the capacity utilization in the corporate sector is around 80%. So there's a genuine demand for loans, and the banks are in a position now to make them. So there's a credit cycle underway, which we think will persist. And then infrastructure, which would mean things like building materials, as a function of the government continuing to roll out improvements in infrastructure. And then lastly, the consumer. As I said, per capita GDP last year, I think, was about $2,600, and by the end of this decade should be about $3,700. If that happens, then consumption is also a good space to be in.
Sure. On Monday, Mark, there was a huge sell-off in mid-caps in India. How do you see that? I mean, because a lot of buoyancy in the last few months has been in mid-caps and small caps. Are they an attractive opportunity from a foreign investor perspective? And what is your sense on what will be the next leg of the rally here in India?
They are attractive because their growth profile is typically superior to the large caps, simply because their base is smaller. But I would say that every stock, no matter how big or small it is, requires an equal amount of work, and people have only so much time every day to look at things. So foreigners will probably not be the ones buying those because they don't have enough time to be looking at mid caps all around the world. They simply don't. And I imagine they would leave that to local fund managers to do, rather than try to do it themselves, and probably not want to have a lot of mid caps, because mid caps tend to be perceived as more speculative and cyclical, and I think foreigners want to buy more structural long-term stories.
Sure. Thank you so much, Mark. That's all we have time for. Thank you so much for joining me this morning.